So as I just shared, in 2021, foundations gave away about 7% of their assets. And so you might be wondering, why aren't they giving away more? Well, this may have something to do with the concept or the doctrine of perpetuity. And the articles of incorporation of a foundation may specify perpetuity, which means that the foundation is required to manage and grow its portfolio of assets to ensure the foundation's ability to every year pay out that 5% minimum requirement. So if they're paying out 5%, they need the other 95% to be invested in a way that replaces that 5% value in perpetuity. Now, a lot of foundation executives and trustees believe that they are obligated to meet the perpetuity assumption. Sometimes it's in the articles of incorporation, often it's actually not. And so it's an interesting question to raise. Why are we asking foundations to have only about 5% of their assets, or 7% in 2021, do 100% of their mission? And is there another way to look at this? So one way to look at it has to do with impact investing. And so I'd like to show you on this slide, which is provided by the Heron Foundation, which is one of the first foundations that really went 100% mission with their investing activity. It's looking at what are called PRIs and MRIs. PRIs are program-related investments. MRIs are mission-related investments. And you'll see across the spectrum that there is a sense of higher risk and lower risk at ends of the spectrum. And again, in this case, you're going to be thinking about higher risk is often correlated with higher returns. We've talked in other modules about reframing that. But in this conventional approach, it is the more risk you take, the more return you expect. So at the end of the MRI spectrum, you're going to see alternatives. So public equities and then alternatives. Alternatives are often like hedge funds and private equity. In public equities, you're going to take more risk and get more return. Fixed income is bonds, cash, of course. And then on the PRI end of the spectrum, the program-related investment, you're going to work your way from cash through fixed income, which is notes, alternatives and novel structures, again, private equity, but in this case, more like what you've heard about about BII's work, like, royalty investing, safes, convertible notes, all sorts of alternative structures, and ultimately grants and recoverable grants. The other way to understand this is that the MRI side is what you do with the 95% of assets. The PRI side is what you do with the 5%. The 5% that you're giving out may be done in the form of grants or recoverable grants, but also in terms of impact first investments. The 95% is an MRI, a financial investment that also furthers the mission. And it has to be considered not charitable activity. It must be made prudently, and that means that it's satisfying the same investment standards under state and federal law as other investments. So it is regulated. MRIs are regulated. PRIs are mission and driven investments that are akin to charitable grants, and they must meet a specific charitable standard, and they do not need to be prudent. So there's a 3-part test for a PRI. The primary purpose must be to further one or more exempt purposes of the foundation, that the production of income or the appreciation of property may not be the significant purpose, meaning it doesn't mean that you can't get a financial return, but it's not the purpose. The purpose is charitable, aligned with your mission, and it also can't connect to electioneering or lobbying. So what we have here is a lot of opportunity because, again, we can use PRIs to make impact first investments, but that's still limited to mostly that 5%. It's tapping that MRI bucket. That's that 95% of the assets of the foundation that are not being used for mission that could be. The challenge is MRIs are looking for market rate returns. PRIs, the challenge is, foundations just aren't really doing it. Less than 2% of foundations engaged in PRIs in 2016. I don't have more current data. So we do have an opportunity as impact first investors to look for PRI investments from foundations, and depending on what type of returns you're going to create, possibly some MRI investments, and that would open up some deep pockets at foundations for impact first investing.